Thank you, Ayo Akinduyite, Associate Director at PwC, for joining me for this quick chat here on Energy Frontiers ahead of the OPEC Alliance meeting on Sunday and the EU price cap on Russian oil. So, how important is the OPEC Alliance final decisions for the year?
In view of current or recent developments in the oil price, I think it seems to be quite an important meeting, being the fact that it's the very last for the year, and more importantly, in view of some of the recent developments in the economic space, particularly with what the oil price is doing. In recent times, we've seen some volatility in the oil price, now dropping well over $100 per barrel. And also with the threats from the G7 and US of, implementing a price cap on Russian oil. So all this put together, and knowing the fact that Russia is a member of the OPEC Plus bloc, so that seems to be potentially a very important meeting in December.
Now, are you optimistic on stronger global demand as we head into the new year?
If we're to go by the GDP projection, we anticipate that the growth in 2023 globally will be slower than the growth recorded in 2022. And of course, as you know, oil price respond to bullish economic activities. And no thanks to, some of, the disruption arising from the COVID-initiated issues in China, which is resulting in slower economic activities and slower growth, by reason of the zero COVID policy of China. So if that continues into 2023, clearly that will translate to lower economic activities and lower GDP growth. The spiraling inflation effects that we're seeing all over the world, of course, we're seeing a fair share of that in Nigeria, where inflation is now over and above 20%. So that would continue to hurt the recovery efforts post-COVID, and that will then most likely have a negative impact on oil demand generally.
Now, tell me your views on plans by the G7 to place a price cap on Russian oil. What could be the wider ramifications if that cap goes into effect?
Yeah, I think it's quite an interesting development. Maybe we'll step back a bit. What exactly is this price cap? Effectively what the EU and America is basically trying to do is to compel or find a way to pressure Russia, and do things that will hurt the economy of Russia in view of the ongoing war against Ukraine. And one way to achieve that is to limit the amount of petrodollar that flows into the economy of Russia. And they're now planning to do that by enforcing some kind of discount, to the price of oil for Russia. And if that happens, I think Russia has made it clear, that for countries that implement such, discount, or price cuts, they will not be willing to make delivery to such countries. And already, from the information that we have, it seems as if a significant part of Russian oil is being sold to India and China. So not a lot of it is going into the countries that are likely to be sympathetic, to EU along this line. And potentially, if Russia goes ahead with its threat of not delivering oil, the implication then is that there will be constrained supply. And of course, the forces of supply and demands have a direct impact on price. So we may then see the price of oil spike up again. But of course, there are a couple of other factors also to be taken into account. I mentioned earlier on the fact that the global economy seems to be struggling post-COVID, so that's moderating the price. And we've seen that in the last couple of weeks, the price now ranging between $80 and $90. So that reduced price that we are seeing as a result of some of the action, relating to COVID restriction in China, reduced productivity, as a result of the low economic growth globally. So that reduction may then be reversed, by reason of not having sufficient supply. If Russian oil is taken out of the oil supply generally, and demand remains largely the same, or particularly in 2023, it's projected that there will be some marginal increase. So if that happens, then potentially we may see a spike in oil price. But having said that, anyway, there's every likelihood that even if that price cap goes on the 5th of December as planned, the impacts may be limited, particularly if the likes of China and the like of India, refuse to implement those price cap. But what may be more significant is the additional action that Europe is planning on February 5th, which is basically to say even the derivatives, over and above just crude oil, that they're just going to take some action and say, sorry, we're not going to be buying derivatives from Russia. So in summary, we see that potentially, if this price cap results in Russian oil not being available or not being delivered, then there'll be some kind of shortfall in supply on the supply side. And if demand remains the same, or we see some level of modest growth in demand by reason of the relaxation of restriction in China, then that could result in some distortion, to the oil price equilibrium, and the oil price may then spike up potentially.
So you spoke a lot about the impact of all of this on the markets, but how should emerging markets and frontier Africa position themselves for the uncertainties ahead of the global energy markets?
Well, I think potentially that may present an opportunity for other, producers. If Russian oil is being blacklisted, so to say, then that may then provide an opportunity for others to optimize value. But unfortunately, for the likes of Nigeria, where we seem not to have been adequately prepared, as we're very much aware, even though the OPEC quota has reduced marginally from about 1.8 million barrels per day to about 1.7, a little over 1.7 million barrels per day. But really our production is still struggling at about 1 million barrels. So the challenge may be that does Nigeria and other emerging markets have the capacity, to ramp up production and be able to take advantage of potentially a high oil price period by reason of, Russian oil not, being supplied in the market, So, and the question, in my view, if you take Nigeria as an example, I think it's very unlikely that we're going to be able to take advantage of that. But, the fact that oil price will go up, the potentially 1 million barrels a day that we produce now will probably then generate additional revenue, which will be good news, music to our ears, so to say, But, I think this should be a huge lesson, for Africa and other emerging markets. Oil and gas business is long-term business. It's a business you need to continue to encourage investment. The fact that we delayed in the passage of PIA had made it difficult. In the last 10 years, there's been no significant investment that has flowed into oil and gas industry. If you step back a bit and you look at the PSCs, many of them were signed in 1993. The first of them started production in 2003, and a few others, 2005, 2006. So that's over 10 years or thereabouts. So even if we get all the variables right now and we get investment in, it's going to take a couple of years before we can then begin to see the value of those investments. So I think it's, there may be opportunities for emerging markets to benefit. But that's one side. And the other side is that, majority of the producers in emerging market are members of OPEC. And Russia is a member of the OPEC Plus group. So is there a possibility that the OPEC Plus group may do some kind of solidarity, with Russia? It's not clear what the line of action potentially could be, but that is not totally unlikely, and I will not rule that out of the table.
So what's your outlook on investments in the fossil fuel industry vis-a-vis the urgency of climate change via increased green energy production?
Well, before the Russian-Ukraine war, the message, was very clear from the developed world, the EU and the US, that to roll back, the issues around climate change, there's a need to reduce the carbon footprint significantly. And one way to address that was basically to say, we're going to stop investing or encouraging investment in fossil fuel, but with what we're seeing, with how the Ukraine war has basically destabilized, the equilibrium of in terms of energy security, and the way Europe is scampering and basically even willing to go to dirtier fuel, so to say, like coal, to go through, the period of to go through the winter period. And it's not really entirely unconceivable that we may still see some level of investment flow into fossil fuel, at least into the foreseeable future. At the recent COP event in Egypt, there were a whole lot of conversation around energy transition and the conversation around gas as a transition fuel, which was the position of Nigeria, looking at gas, as that bridge, and that will help the country to transit to greener energy. So that's becoming a more acceptable option, and those gas projects are likely to be able to attract investment. And of course, there are also a lot of conversation around carbon trading, that yes, you may commit some carbon sin, but if you're able to do some things, to then make sure that at the end of the day, you're able to attain a net zero position. So it may not be such a bad thing. So I believe, taking into consideration some of these variables, in the next foreseeable future, I expect there will still be some investment flow into fossil fuel. But having said that, I think it's important to clarify that for the case of Nigeria, it's absolutely necessary for us to get the basics right. We have passed the PIA, it's over a year now. We're not seeing the kind of investment that we thought we were going to see, because we all thought, with the very beautiful fiscal provisions and incentives, provided in PIA, and the clarity, and the regulatory reforms, that PIA has introduced. We thought investors would basically running and jumping in, with investment into the oil and gas industry. But surprisingly, that's not the case. And that may not be unconnected with the fact that we have other issues, issues around funding. The players in the industry are complaining that the government, particularly with respect to JV, is not paying its share of cash costs. So that may not encourage new investment to come in. But clearly, the elephant in the room is also security. So I'm sure we've been following conversation, particularly with the group CEO of NNPC Limited, and some of the effort that they've made, But that's really quite disappointing. We've lost close to half of our capacity to produce. We have not been able to put anybody, hold anybody responsible apart from the crew of those, the ship that was apprehended recently. So to have such huge impacts, with respect to security, with respect to crew theft, and the Minister of Petroleum, who incidentally is the president of the country, has not really done anything fundamental, anything significant to address this issue. And the the group CEO of NNPC coming out to say that his life is at risk. Is that an indication that criminals have basically hijacked the running of this country? The main resource. So clearly, if we don't address the issues around crew theft, with some level of seriousness and sincerity on the part of government, it may be difficult to expect that they will see some reasonable investment flow into the oil and gas industry.
Wow, interesting insights right there. And thank you for coming on the show, sir.
Thank you for having me. Thank you very much.
All right. I'm Justina Okechukwu. See you next time on Energy Quick Chat here, where we speak to leaders from the energy sector. Bye for now.